In 2023, Red Lobster lost $11 million on all-you-can-eat shrimp. Every headline blamed the shrimp. Every headline was wrong. 11 million is a rounding error for a $2 billion company. The thing that actually killed Red Lobster is a stack of paper signed in 2014. A real estate deal worth $1.5 billion. Almost nobody read it. We did. And once you see how it works, you'll recognize the same move behind half the dead brands you grew up with. First, feel the size of this. Red Lobster wasn't some struggling startup. 56 years old, roughly 700 restaurants at its height, 64,000 employees on the day it filed for bankruptcy. You've probably sat in one of those booths. You've definitely heard about the biscuits. Now imagine this happens to you. You own your house, paid off. Then someone buys your life. And to afford it, they sell your house out from under you and sign you up to rent it back. Forever. Rent that climbs every single year. You didn't get the money from the sale. They did. You just got the bill. That's not a metaphor. That is almost line for line what happened to Red Lobster in 2014. More than 500 buildings. $1.5 billion. Gone in a day. And from that day forward, every Cheddar Bay biscuit had a landlord. Quick note on sources because it matters. Nothing here comes from rumors. It comes from Chapter 11 filings in a Florida courtroom, the restructuring CEO's sworn declaration, and the investor reports of Thai Union, a publicly traded company legally required to disclose its losses. Here's the thing about dead companies. They finally stopped doing PR court documents are where the truth lives. So let's read them. Claim number 1. Red Lobster paid for its own funeral. In 2014, Red Lobster's parent company, Darden, was under siege from activist investors. They wanted the chain gone. So Darden sold Red Lobster to a private equity firm, Golden Gate Capital, for $2.1 billion. Here's where it gets interesting. Do the math with me. The same day the deal closed, Golden Gate sold more than 500 of Red Lobster's buildings to a real estate trust for $1.5 billion, then leased them straight back. 1.5 of the $2.1 billion purchase price came out of Red Lobster's own walls. So who really paid for Red Lobster? Red Lobster did. It's called a sale-leaseback. On paper, totally legal. Routine even. Darden's own shareholders screamed fire sale anyway, because here's what it actually does. It converts a company's safety net into someone else's payday. The buildings Red Lobster spent 5 decades acquiring. Its cushion for bad years became rent checks, roughly $200 million a year with built-in increases. Takeaway 1, write this down. When a buyer pays for a company with the company's own assets, that's not an acquisition. That's a harvest. Anytime a brand you know gets bought, ask one question. Who kept the real estate? And rent? Rent sounds boring. Stay with me. This is where it turns brutal. Claim 2, companies don't die from losses. They die from fixed costs. Think about your own budget for a second. If your income drops 30%, what decides whether you survive? Not your salary, your fixed costs. Low rent, you bend. High rent, you break. Now scale it up. Before 2014, Red Lobster owned its buildings. Bad year? Tighten up, ride it out. The real estate was a shock absorber. After 2014, that shock absorber became a treadmill. $200 million a year in rent, contractually climbing, at rates the company's own bankruptcy lawyers would later call above market. Then the bad years actually came. Casual dining traffic slid for a decade. Court filings show Red Lobster's guest count fell roughly 30% between 2019 and 2024. Inflation spiked wages and seafood costs. Revenue sat around $2 billion, but roughly $1.10 walked out the door to landlords before a single shrimp hit a fryer. Healthy restaurants fight to keep rent near 6% of sales. Red Lobster's weakest locations were drowning far past that. And here's the cruel part. You can cut staff, you can cut shrimp, you can cut hours, you cannot cut a long-term lease. The 2014 document didn't just take the buildings. It took away the company's ability to shrink in a storm. Takeaway 2, nobody dies from one bad quarter. They die because fixed costs can't flex when revenue does. The same rule runs your household. So who was steering the ship while the water rose? That's where the shrimp finally enters. And it's worse than you think. Claim 3. Endless shrimp wasn't a dumb promotion. It was a symptom of who owned the company. 2016, 2 years into the Rent Treadmill, Red Lobster gets a new investor, Thai Union, one of the biggest seafood suppliers on earth. They paid $575 million for a 25% stake. By 2020, with partners, they controlled the whole company. Read that ownership chart again. The company that sells the shrimp now owns the restaurant that buys the shrimp. June 2023, Ultimate Endless Shrimp, for years a limited twice-a-year event, suddenly becomes a permanent $20 menu item. Customers camped in booths for hours. TikTok turned it into a sport. Red Lobster lost $11 million in a single quarter. Management panic raised the price to $22, then $25. Too late. Everyone laughed. Ha! The all-you-can-eat math failed. But ask the better question. Why would anyone make a money-losing deal permanent? The bankruptcy filings point at an answer. Red Lobster's restructuring CEO stated under oath that the company was investigating Thai Union's role, including how Red Lobster dropped 2 other shrimp suppliers and leaned harder on Thai Union's own supply, driving costs up. In plain English, the filing raises the question, was Endless Shrimp a customer promotion or a sales channel for the owner's shrimp? Takeaway 3, incentives beat intentions every time. When your supplier becomes your boss, menu decisions stop being food decisions. Watch who profits from the order, not who places it. By spring 2024, the math ran out. Claim 4, the bankruptcy itself tells you what the real murder weapon was. May 2024. With almost no warning, Red Lobster shuts more than 90 restaurants in a matter of days. Entire kitchens, ovens, fryers, lobster tanks dumped into online auctions. Then, May 19th, Chapter 11. More than $1 billion in debt. Less than $30 million in cash. 64,000 jobs in the air. 56 years old. Now here's the tell. When a company goes bankrupt, watch what its lawyers attack first. It's the most honest org chart you'll ever see. A ranked list of what was actually killing the business. Red Lobster's lawyers didn't attack the shrimp. Their first big move was the leases, rejecting more than 100 of them and renegotiating the rest, calling them burdensome and above market. The exact leases created by the 2014 Sale-Leaseback. The survival plan, filed in federal court, was undo that document. That's the confession. And it worked, sort of. September 2024. A new owner, the investment firm Fortress, takes over. A new CEO, Damola Adamalekan, 35 years old, fresh off running P.F. Chang's, Thai Union walks away and writes off over $500 million. Red Lobster survives. Smaller, lighter, with rent it can actually pay. Takeaway 4: when something collapses, skip the headlines. Find what the cleanup crew cuts first. That's the real cause of death. Which brings us back to where we started. Endless shrimp didn't kill Red Lobster. An $11 million mistake doesn't kill a $2 billion company. A $1.5 billion document does, signed a decade earlier, ignored by almost everyone. Because real estate contracts don't go viral. Shrimp does. So here's your one action. Next time a brand you grew up with suddenly dies, search its name plus the word Sale-Leaseback. You'll be amazed how often the murder weapon is a lease. Sears did a version of it to itself. So did half the stores in your dead local mall. That's what this channel does. We read what dead companies leave behind. The filings, not the headlines. Next autopsy, Tupperware, 78 years old, dead in 18 months, and the warning was sitting in public documents the entire time. Subscribe if you want the paper trail. The filings don't lie.